Hello, everybody. Hope everyone had a good Christmas holiday and New Year's. The weather's been kind of cool, but it is winter. This is the first webinar for Fluent Financial, January 2025. Joining me on the call today is Trey, Talley. We're going to cover the same information we normally do. I know the fourth quarter was kind of a difficult quarter for the markets, specifically the bond market, but it's still a good place to put money in, especially with the economic data continuing not to look very promising. So to get started, we'll cover the first slide is the compliance slide that the opinions expressed by myself and Trey are Fluent Financials and not private client services. So Trey, I'll go ahead and turn this over to Trey. Why don't you kind of talk about the market performance? And I think what's interesting here is how poorly the market has done in a lot of different areas, specifically bonds.
Yeah, thank you, Mitch. Hello, everybody. So kind of starting back in 2022 when all the fun began, it's kind of what we're looking at here for markets. We got a number of indices up there. Large cap growth, particularly in the tech sector, has been doing really well. You'll see that up kind of 27 and 23% respectively over that time. Most of the other market has really just kind of struggled over the past 3 years. We've got kind of your international indices and small caps, which are up a paltry 6 and 2%. This is with buybacks, with dividends over these 3 years, really just recovering their par value at this point. Emerging markets and bonds, that's been where a lot of the pain has been. Inflation is still with us. We have had above target inflation for over 3 years now. We started to make some great progress on that in 22. Heading into 23, fiscal impulse from the government kind of stalled a lot of that and created a lot of persistent inflation that we're still battling today. Good news is there's a lot of disinflation coming to us in 2025 and some of the stickier elements. But bonds have really suffered over this time because rates have stayed high to try to combat inflation. We'll talk about what's going on in the markets today. This year, and kind of recap last year on a bit of a drawdown in most of the indices right now. We'll talk about what's going on in the economy, some of the resilience there, kind of what the outlook looks like for this year. Next slide. Let's take a look, as we always do, at the leading economic index. Mitch will get that up here. There we go. So white line is kind of the index, which comprises about 10 different leading economic indicators from the conference board. And the more gold line there is the S&P 500. Generally should move in correlated fashion. Stocks and the market should be correlated to quite a high degree. We really haven't seen that through the balance of 23 and 24, mainly because of the asset bubble. It's been really concentrated in the tech names. They're more idiosyncratic in nature. We see that spread there. It's quite wide. Generally, any spread movement that we've seen over the past 60 years does close by a number of factors, whether the market's going down, economy improving, or some sort of combination between the two. Right now, we're at quite a dislocation. Next slide there, kind of take a look at what's been going on last year in returns, both at the indices and portfolios level. And so last year, again, we already alluded to much of the strength in markets were concentrated in kind of the Mag 7, the Magnificent Seven names. It's the 7 big cap names that have fortified balance sheets, innovative moats around their business, and were able to find performance when most of the market was quite benign last year. So again, we've kind of discussed emerging markets, small caps, even international stocks really not joining that party. It was really a story of the NASDAQ in the tech-heavy S&P 500, which did quite well there, up about 29 and 25% respectively. The S&P equal weight, which is kind of the answer to the question of what has your average stock done. It's still skewed in nature, but it was up just under 13% last year, but a big spread between the equal weight and the cap weighted indices. Again, that gremlin is these mega cap names that kind of ruled the party last year. To see the rest of the market participate, that's what we'd like to see. To have that happen, we really need the economy to get some steam going. And that just really has not happened domestically or internationally. We've continued to see anemic growth here in the US, really contracting growth in Europe and in Asia. And so hopefully we can get some good news on that in the future. The 60-40 did about 10% last year. Our returns last year were much lower than some of the larger cap indices. They were more in line with kind of the average stock portfolios like the equal weight and has been a global 60-40 portfolio. We really want to practice capital preservation here. We're not a vehicle that tries to beat every asset out there. We are a vehicle to make sure we get you to and through retirement with the highest probability as possible. There'll be years when we do phenomenal against some of these indices, and there'll be years when we don't. Going forward, there's going to be a large hangover kind of from some of these tech names and the indices. They're going to make performance for them over the next 10 years quite poor, and us as an active management vehicle will be able to do quite well in that portfolio. So not to be long-winded there, just kind of wanted to recap some of the price action we saw last year. And with that, we'll kind of move on here. So hope slides, we're going to take a look at kind of where the pain is in the economy, where the strengths are, and that ranges from housing to employment. We're focused on employment, but we start with housing here. Home builder sentiment. Trump did win in November. That has helped boost some of the sentiment. Home builder sentiment is still contracting at this point, though. Some of the optimistic points are reduced regulation that is presumed through the new administration. Some of the more pessimistic points remain around slow housing activity from consumers and high interest rates that are still dampening some of the mortgage activity. Building permits, much of the same story. We really haven't seen a takeoff there. Just under 1.5 million annualized. And that's even, we see some of the rates that came down at kind of a portion of last year. We really didn't get a bump up in housing. That's really telling of the demand side that there's really not some demand that we can tap into when rates go down quite yet. All that money is locked up in home equity. Nobody really has any money to do anything outside of that. So housing remains pretty weak. Open orders, that's the next one here. We look at manufacturing and services, mortgage purchase act. And this is one we added this time, so I apologize. This just is an index of the mortgage purchase applications. And so we see here mortgages are at over a 20-year decline. Pretty weak here. We have not seen any pickup there. If the economy is going to be doing well and the rest of the stocks are going to start participating in this, it'll show up in housing. It hasn't yet. With that, now we'll kind of go on to the open order slides there. Real quick, manufacturing, it's been kind of the laggard, and that's the same here as abroad, and that kind of continues to be the story. We did get a bump up in new orders there to over 50 for the manufacturing sector. That's mostly, unfortunately, being driven by front running ahead of presumed tariffs. We'd like to see it being driven more by organic demand. We are seeing some life in the manufacturing sector. That's something we want to make note of. The headline index is still contracting, so we do have to take that with a grain of salt. Services has been the bright spot of the economy, but it is waning here. It's still expanding at above 50. Again, above 50 is expansionary territory. We've seen really just kind of a to and fro from this, a slow drift lower. As this slides into contractionary territory, that usually coincides with a recession. It generally looks like the trajectory that we're on here. We want to see this pick up or at least remain resilient while manufacturing improves. To get bullish, that hasn't happened yet.
Yeah, and Trey, the next slide, this is manufacturing. We got these out of order, but I think this is important. You mentioned this before, that the European area is basically in a recession, but we just don't see a very healthy economy outside of the U.S.
Yeah, so global manufacturing has been really weak. Talked about China. Germany economy has contracted actually for 2 years straight. That's the first time since 1950 that that's happened. So with the chart we're looking at here, the blue line is just global PMIs output. We're really just kind of been humming along, kind of splitting the fence between contracting and marginal expansion. But for the most part, we haven't seen any acceleration when we take a global outlook. Manufacturing generally doesn't portend well for economic expansion.
And I think it's important because if manufacturing and housing aren't really growing, the economies are not growing. And it's hard to say, well, I should have a bunch of money in stocks because, well, that's where the great returns are. Not now. And what I think is an important point, we'll see this during the webinar today, it's where we're going is we're looking through a windshield, not a rearview mirror. And the theses that we've had last year are still in place today. So we're not going to be making radical changes and taking risk. It does not make sense to do so. So Trey, if you look at the profit sector, this is a continuation of many months. We have a divergence between the stock market and earnings per share from the companies. It's not sustainable.
Yeah, so profits for most of companies, so S&P 500, 493 of them saw either flat or negative earnings last year. Any and all earnings growth came from these 7 magnificent names last year, very concentrated and narrow participation. Through the balance of the year, we saw earnings estimates just continually slide down, and that's created kind of a spread here, which has widened multiples in the market. I mean, the market has become incrementally expensive from a valuation perspective. And so while returns may still be present, the risk you have to assume to get those returns is quite high here. Finish off on employment here. Kind of take a look here. So this employment has been where we've been focused and fixated since about the balance of the back half of last year. And we've seen a few scares, particularly in the summer, but we've seen largely resilience in the employment sector. Unfortunately, it's been driven by inorganic measures like government jobs, healthcare, and education. We saw kind of a run up there into the election where we saw a lot of election hiring, which helped boost some of the employment figures. What we're looking at here is initial and continuing claims for job employment. Quite plainly, if the economy is doing well, nobody needs unemployment insurance and vice versa. What we're seeing here is kind of the initial claims, which have kind of hovered between 200,000 a week and 250,000 a week. That's consistent with kind of a resilient job market. What is not so great is the continuing claims that continue to move higher. So if you are finding yourself unemployed, you are staying unemployed. Hiring activity is basically non-present at this point. And so those measures both moving up generally start to lead us into a recession. Last one we look at is unemployment. Unemployment rate ticked down from 4.2 to 4.1 through the month of December. Some seasonality there, some rounding, but for the most part, we've seen kind of stabilization in the unemployment rate. That's good news. We have unfortunately stayed above kind of this 2-year moving average for the unemployment rate, which we've overlaid here in gray. When the unemployment rate's above that moving average, that starts to tell you it's on the move higher, and recession generally follows after that. Something we want to keep an eye on there for employment. So with that, go ahead.
Yeah, and I'd like to expand on the labor on the employment. It goes to the labor demand. The JOLTS report basically talks about job openings seasonally adjusted, and on this chart on the left, you see this plunging of job openings. Up here in the upper right, the JOLTS quits. This number is decreasing, and this basically means that if people feel like they can get a good job if they quit, this line would be upward sloping. It's not, it's downward sloping. And then the last slide, or the last chart on this slide on the right, it shows the layoffs is starting to increase. So this kind of is it basically backs up the previous slide showing that the unemployment is starting to creep up, and this is the last domino to fall before we have a recession. Now, labor supply is kind of interesting. We look at non-farm payroll gains. And what you look at over this 4-year period on this dark line is a trend that's downward. And you see payroll gains, but it's decreasing. And a lot of the jobs that were added in the past 4 years, 1.5 million specifically, were federal government jobs. Now, with the new administration, with the DOGE program, I don't know how many of those 1.5 million people that have federal jobs feel good about their job security. The other thing that's interesting is if you look at this chart on the lower right, the labor force participation rate. If we have a growing economy, everything's healthy, you would see the participation rate picking up, and we don't see it. So you have men and women both decreasing, people over 55, it's decreasing. Sources of population growth, we have a problem in this country. It's not as bad as Asia and Europe. When you have the birth rate of women and child rearing years below 2.1, your population is decreasing. We've helped mitigate that with the immigration. You can see this big spike of immigration that we've had over the past 4 years. That's not going to be happening with this administration. I'm going to shift gears now and look at the stock market evaluation. And the reason why we've been so hesitant about adding a lot of money to stocks and increasing risk is the price earnings ratio and then the CAPE ratio, Robert Shiller's measure. And these numbers are very, very high compared to their long-term average, 30-year average of 16.9. And the last time they were above this level, you go back to the dot-com market conditions before it collapsed. And then back in 21, then we had the collapse in 22 when both the stock and the bond market decreased. So it does not make sense to add the equities at this juncture unless it's very conservative equities. And that's basically what we did in the fourth quarter. But technology continued to grow, and with more interest rate sensitivity, some of the more value or risk off equities did not do as well in the fourth quarter. It doesn't mean you should get rid of it. And we don't have a FOMO bias, fear of missing out. We're going to keep our hands on the rudder because we do see stormy seas ahead. So if we look at this next slide, bear with me 1 second. This is the expected returns going forward. The chart on the left represents the 1-year expected returns. And this is red diamond. These data points here are what historically has happened. This is the rate of return on the y-axis. The x-axis is the PE. When you have an elevated PE, the expected returns are more often more negative than positive. And if you look at the one on the right, this is for 5 years. Again, you see a very low single-digit returns in the S&P 500 index. Trey had mentioned earlier that the passive investing, the indexing that has served people well for many years, going forward will not. Active investing, whether it's individual stocks or bonds or strategies, will outperform the indexes, and that's the windshield we're looking at, down the track, so to speak. So this is what's really important. So the next slide I want to talk a little bit about, we haven't talked about oil in a while, and it's been really interesting. If you listen to conservative media, it sounds like the Biden administration didn't really help the oil industry that much, but if you look at the U.S. production, it has continued to grow during his administration. Now, the number of active rigs here in this chart here, which is the blue line, has actually decreased. But the part that's really disconcerting is this gray line here. This is the strategic reserve, what we have in inventory in case of emergency, like a war. Well, the Biden administration, to help ease the inflation they caused, they released a bunch of oil in 22, and they never replenished it. Now, oil's around $70, $71, $72 a barrel, and we anticipate the price of oil will go lower because when the Trump administration gets in, he started, drill, baby, drill. What that basically means is they're going to allow more drilling on federal land or offshore, where the Biden and the Democrats prohibited that. But if you have private land, they can't tell you can't drill. So that's why the oil production increased, plus the active rigs with the better technology. We're getting more oil and gas out of wells because of the advancements. So that's what we see happening. Now, the next slide, and we're kind of just hitting some points we want to talk about briefly. The tariffs have come up a lot in a lot of discussions. And Trump, who is a very quiet individual, he doesn't have very many opinions. I'm being facetious, but he's talked a lot about tariffs. And tariffs is going to be a negotiation tactic. If you look at the tariffs, and on this chart here, these are percentages on the y-axis. The x-axis is year, so this is 1930. So you look at the 1930s, and that was the Great Depression. We had pretty high tariffs. That was one of the reasons why our country really struggled. But as you go from the 30s all the way up until about 2017, when Trump got elected in his first term, tariffs decreased. So Trump gets in and he brags about all these tariffs that were raised. It was like 1 or 2%. And this is the proposed 20%. It's not going to happen. But the threat of that has spooked the bond market and did cause interest rates to spike up in the fourth quarter. When reality happens, the bond market's going to realize, oh, this is a negotiation tactic. You're going to start to see yields decrease. And there's some other points we'll bring up that will show where yields are going to be decreasing. And if we look at the inflation components, and we normally have shown this with a Bloomberg slide, we're using JP Morgan's. It's kind of the similar data, but a little bit different. Bloomberg likes to have a black background, which is hard to read. JP Morgan's a little bit easier. But what I want to point out is the areas that remain stubborn: shelter. And this is the rent, owner equivalent rent. And when you rent an apartment, you're not going to rent it for a month or two. You're looking at a 6-month, 1 year, 2 year, 3 year lease. And back then when inflation was higher, the landlords were able to charge a lot more money for rent. So you can see this uptick here in the blue bars. And this has been the sticky part. The other part that's been very challenging is auto insurance. Cars are much more expensive, a lot more technology. And a lot of the features they have on cars with the flat screens causes more distracted driving. When you drive down the road, notice how many cars have front end damage. It's ridiculous. You guys know I do stuff on the track. We have toggles and switches that you can feel because you can't take your eye off the road because bad things can happen. Well, I think that's part of it to do with this auto insurance. That will remain somewhat elevated, but the rental insurance will come down. So this next slide goes a little bit more detail about the actual owner equivalence rent. And Trey, I'm going to turn this over to you because you had some really good points in our practice run this morning.
Yeah, so we're looking at two lines here. The white line is the owner's equivalent rent year over year. And so this is when you own your home, even if you paid it off, the government says, well, you own your home and we have to assign some sort of opportunity cost to you owning your home, because if you didn't, you'd be renting elsewhere. And so we're going to assign and impute what's called owner's equivalent rent. And we're going to measure that as a function of inflation into our input of the index. And so the white line here is showing 4.92% year over year for owner's equivalent rent. To be clear, this is inflation that already happened years ago in 2021. But because of the methodology of the government, they smooth this out over a number of years. Otherwise, you'd be seeing month over month inflation of 15, 20% for several months, and it would cause an absolute panic. And so they kind of smooth it out. And so the red line you're looking at is, well, that was what happened then. What's happening now? And so the Cleveland Fed has a new tenant rent repeat index. And so that is looking at, if you're going to sign a new rent today, what's that rent inflation look like? And the new rent index is showing about 1% inflation, and those are real time. And so these two different measures have about a year plus or minus a lag there between the new rents and the rents that we will eventually see make their way into the CPI index. And so if we kind of fast forward through 2025, some of the sticky inflation that we're seeing that's keeping the CPI based above the Fed's target is actually going to be materially lower. So from this 4.92 a year, maybe 15 months from now, we'd expect that to actually be only 1%. That is below the Fed's target rate. That is good news for the inflation from the inflation front. Yields will come down as the Fed is able to cut in the face of that. So that is some of the good inflation news that is coming to us through 2025. We'll kind of move forward there to the interest rate projections. So big shock from fourth quarter to today has been the reduced outlook of the Federal Reserve rate cuts that are priced into the curve. That has been because we've come out of that summer swoon where Japan was down 20% in 2 weeks. Our markets were down 10% in 2 weeks. We got a triggering of the SOM rule. We got a negative payrolls report, unemployment rate had spiked up. Things got really bad really quick. In the ensuing months, we've got some stabilization in the data. So yields have kind of come back up there. And then we got Trump as the encore to that, which introduces a lot of uncertainty with respect to growth and inflation driven by tariffs. So the Fed has just kind of said, in light of all this uncertainty, let's just kind of take a step back. What that means is the cuts that are priced into the curve have kind of come down. We were looking at over 1% of cuts through the balance of this year just a few months ago. Now we're looking at about 25 basis points. And this is fluid. This is going to change. You get a bad payrolls report. Suddenly we're going to start to get more cuts. You get recessionary signals again. We're going to be cutting like loggers. But right now, that's kind of why some of the term premium and yields, that's long-term bonds, so they've come up here. It's just there's a lot of uncertainty. The Fed's going to kind of wait and take a breath, see what's going on. Again, the Fed has got rates high because activity is too strong and they need to slow it down. So their job is to slow things down, reduce growth, reduce inflation. They will do that, no doubt. We just need a little bit of time here. So.
Yeah. And Trey, what's interesting is I've added this slide in here because I think it's not a different take, but it kind of expands and shows the history of what the Fed has done historically. So this goes back from 1993, and this shows the Fed funds rate on the y-axis. What I want to focus on is when the rates are high and we have a recession, look how quickly the Fed cuts rates. Here's the dot-com recession. Here's the Great Recession. This is the COVID. And they just raised rates significantly because we were spending money as if we're fighting World War II. What I want to focus on is this area right here. The blue lines are the Federal Open Markets year-end estimates, and the market expectations are here. The markets are not expecting a recession with the data, but that information, as Trey mentioned, is incredibly fluid, and we don't agree with that. We think we're going to see something like this in this with the bond market. So you're going to see a much more aggressive rate cut down. It's not going to be a straight line down, but we think it will be a little bit faster. But again, the long-term rates are expected to be 3%. So Trey, on this next slide, why don't you talk a little bit about what's happened with the market returns around this cycle and why the rates got cut, but the 10-year returns have actually been negative on this right-hand side, and then what the S&P does when the rates start getting cut.
Yeah, so left side here, you're just looking at different analogs, looking historically back. What happens to the market when the Federal Reserve starts to cut? You'll see kind of a bifurcated data set there, depending on whether you get a hard landing or a soft landing. Soft landing meaning the Fed is able to reduce inflation back to target, jobs stay in there, the economy doesn't shrink very much at all. Conversely, hard landing, employment crashes, the economy contracts, stocks really suffer. What we've seen through that red line in 2024 is markets generally kind of along the analogs there. The Fed was reacting to that summer swoon. They cut 50 basis points right up front just a few months ago because they were thinking we have arrived very late to the party. We better start cutting rates very quickly because the recession is at our doorstep here. Data's kind of stabilized, new administration, a lot of uncertainty. So we kind of see that reaction on the right side of that portion of the chart there, which is showing what have yields done since the Fed's cut. And yields have gone up quite a bit, about 100 to 110 basis points since the Fed's first cut there. What people have been scratching their head, what's going on here? Very same story. Data stabilized, new administration, lots of uncertainty. Yields want to price that back in. So bonds have kind of come back up here to about 4.7 to 4.8% there. That is an anomaly when we look back. Doesn't matter if it's a hard or a soft landing. The yield pickup here is quite unique. Yields are at a good fair value here. We'll talk more about that as the slides go on.
Yeah, I think the important point here is if you look at all the lines here, you're looking at 10% return within 6 to 12 months, and we're negative about 3 or 4% right now. So again, it's a timing part, but when they've done rate cuts in the past, the 10-year Treasury all had positive returns basically within 3 to 6 months after they started cutting rates. So I think that's really, really important. And this next slide and kind of give you a history of the bond market on a long-term basis. So this goes back to 76. The gray bars represent what did the aggregate bond market return, and then the red dots represent what was the market low. So last year, the aggregate bond market did 1%, but it had a negative 4% drawdown at the maximum level. In 22, which was the worst year ever in the bond market history, it lost 13% for the year, but it dropped 17, and the equity markets went down. And that's what we were talking about at the beginning. The markets, with the exception of large cap growth, haven't performed that significantly well for 3 years. But the other part is the bond market's been up 44 out of 49 years. So it just kind of gives you an idea that we're wanting to keep assets in a conservative position. Now, the other chart I want to talk about is the history of the bond market and expected returns. So when you look at this, you look at the starting yield on the x-axis and then the subsequent annualized 5-year returns on the y-axis. Now, we had rampant inflation in the 70s and the 80s, and it kind of peaked in the 80s, and Volcker and Reagan said, we're going to kill inflation, and they did. But those of you, many of you on the call, your first mortgage was very, very high, double digits, and that's these dark blue lines here. And this shows the subsequent returns in bonds, 14, 15, 18% returns in a very conservative bond. But as rates continue to fall down, and as this curve, you migrate southwest on this curve, we get to basically the 0%, or bonds are priced over perfection for most of the teens. That's the orange areas here. Now, if rates have back up, we're in the areas of the early aughts in this green area here. So your expected return is going to be about 5% with a 5% yield starting. And the reason this is significant, we'll show you a chart here in a little bit. That's about what you're going to get in returns for stocks for the next 5 years. And stocks have significantly more risk at this level now. So we want to keep in the lifeboat, not jump in the water where the shark fins are swimming around, and stay in bonds until it makes sense when the sharks have disappeared, then go back into more heavy equities. And this next chart talks a little bit about the valuations. And you look at the different asset classes here, and the charts on the far left, when you look at the valuations, the Z-scores, it's kind of like a price earnings type thing. Stuff on the far left, the green and the current price, this is an extremely good price to buy into today. This is kind of a break even at 0. Then you look at the other side of this graph, what's very overpriced right now? U.S. growth, U.S. large cap. This is your tech. This is your Mag 7. High yield bonds, which are not really bonds, are basic equities appearing as like wolf in sheep's clothing. Then it kind of decreases as you move left. But this is the area where you want to allocate money now because that's the best price. And this next slide, Trey put this together, and I think it's a very good summary. We're going to be using this in our meetings for the first quarter. And what I like about this slide is it basically says, where are we at in the economic cycle? Are we in early expansion after a recession? Are we mid-expansion, late expansion? Are we in a recession? But what you look at is the returns. Stock market is the green, the bond market or treasuries is the light blue. So I think everyone on this call would agree we're in a late expansion. And these are the expected returns going forward. Stocks and bonds are going to be identical, basically. We go into a recession, you can see what the delta is here. You look at this is a 35% difference between equities and bonds. So this is the data that we look at day in and day out. And people say, I don't want to be in bonds. I don't like bonds. They haven't done well. They didn't have a good year last year, blah, blah, blah. Again, people, we look at our windshield going forward, not our rearview mirror. And Trey, this next slide, I want you to comment on, because I think we need kind of give people some context of where we've been historically, because we see a lot of similarities between the late 90s and today.
Yep. So the charts we're looking at here are the past 20 years from the dot-com darlings. So that extends from 2000 to 2019. And so some of you will know these names quite immediately, whether it be Cisco or IBM or Intel. A lot of these companies were seen at the time as really on the frontier of changing the world. That these were must-own companies at any price, and the perception is that sales are going to grow for these companies quite strongly, and they are truthfully going to change the future, and so there's no wrong price to buy them. And so you kind of have three boxes here. When we look back over the ensuing 20 years after 2000, those companies no doubt did change the way we live life, both societally and professionally. And so that top box is the fundamental growth. Sales for these companies grew over 1,000% over the almost 20 years since that 2000 mark there. The bottom two portions are more of the stock related metrics. And so the middle one that you see there is the multiple expansion. And so in 2000, these companies were trading at incredibly high multiples, price to sales ratios of over 30, which means you need to own the sales of the company for over 30 years before you get to pay back the equity that you invested there. We saw drastic multiple compression over the next 20 years because no doubt these companies did change our lives, but they were priced for perfection and they pulled in a lot of the future. And investors were buying assets at nosebleed valuations, and ultimately they ended up overpaying. So the sales of those companies went up, the multiples compressed. The bottom one is the total return. If you bought in 2000 and you got all the buybacks that the company did, you got all the dividends that the companies did, your total return over the next 2 decades was 16%. That is kind of starting to sound very familiar with some of the AI names that we've been talking about over the past 2 year or so now. So your AI, your cryptocurrency, your quantum computing stocks, no doubt they are great companies. They have an amazing innovation that is going to change our lives for the better going forward. But we are investors and we don't get to buy narratives. We have to buy stocks. And when you buy stocks, you have to care about multiples. And the way do you think about valuations is think of them like an airplane. And an airplane's run off of 2 engines. And you have liquidity on one side and you have the macro economy on the other. Right now, we're being fueled only by one engine, which is the liquidity, because the economy has been very weak. As valuations grow higher and higher, your elevation grows higher and higher. So if that plane, the engines go out, it is quite a disastrous fall. You fall from 5 feet, you're fine. You slide down the ramp, you go up to a new airplane, everything's fine. Right now, we are very high elevation in that airplane, and the only engine that's running, which is liquidity, is starting to sputter. When we start to go down, it is not a safe flight down. The companies that that have really carried the indices for the past year or two, they're starting to sputter. NVIDIA hasn't made a realized new high in about 7 months now. Why is that? We're going through a digestion period. That is a very bumpy ride. You do not want to be along for it. 2025 is going to be very different in markets. We have to fight the behavioral biases here that what has happened will continue to happen. There are some great companies out there at low valuations that can ride this thing out, protect money. That's where we want to be, and bonds fit into that conversation as well. So again, great companies, great story, bad valuations, bad outcome for investors right now. You do not want to be on that airplane. Kind of moving forward there. So this is funny here. Prognosticators, we are a humbled a lot. And so what we're looking at here is just 4 different years, and we're looking at Wall Street desks, and we're saying, what was your price target for the following year? And then we kind of look back and say, what did markets actually do? And so in 2022, top left there, it was seen that the markets would go up kind of below trend, but about 4% growth. And they got pretty close. It was about 18% negative for that year. So that's pretty close. 2023, they said, well, 2022 was rough. We'll kind of have maybe a rounded 12% gain there. And they were directionally right. They got the magnitude wrong. We were up over 26% in 23. 2024, they looked at 23 and said, whoa, we went a long way pretty fast. Surely we're going to cool down in 24. We're going to be basically flat through 24. So they were pretty close. Markets did almost 25% that year and staged a rip-roaring encore. Now that was off of a low base, etc. And so we look to 2025. What do the markets see? 2025, we're seeing kind of above trend there, about 12%. Most of these desks say, yeah, valuations are high, but they're going to stay high because that's what smart people do. What this is trying to say is, look, these are the brightest minds. They got more degrees than Fahrenheit or Kelvin in their desks. They're putting out these reports. They're very well of the numbers. And it's just so hard to know these things ahead of time. And anybody who tells you that they do know these things and that they've got some special crystal ball, just run for the hills. And so we've certainly got a few things wrong over the past few years. But what we've done is we've done it by the book with prudence and care, not chasing waterfalls, making sure that we can look our clients in the eyes with a full portfolio at the end of all of this. So it's poking fun at Wall Street, but it's just humbling ourselves as we are in kind of great company there.
Yeah. And the next thing I want to talk about, and Trey, actually, I'm going to let you talk about this. We've used the long-term bond fund from Vanguard, extended duration EDV as its ticker, but Trey and his team found a new product that came out last year that it's pretty significant. We're going to be having bonds here in the near future, and this is something that we've added to the portfolios. A lot of you have seen trade confirmations for this simplify downside risk rate hedge strategy ETF. It's basically a ETF bond fund that has some option exposure that gives you the upside when rates decrease, and it has the same downside exposure as the EDV, which it replaced. So why don't you expand on this, Trey, and tell people why this is such a good investment?
Yeah, so we like EDV because its underlying is long-term U.S. Treasury bonds that offered good yield, good coupons, and they rally really strongly when markets start to go south. And really, that was kind of the best out there. Towards the end of last year, one of our ETF partners launched a new solution that's really intelligent in design and was what we would kind of refer to as a better mousetrap. Not much about the underlying changes. It's still a bet on long-term Treasury bonds. It is strategically, the objective is to try and hedge when interest rates go down. And so this product rallies when rates go down, much like all of our EDV positions did. Good kickers for this is we can express the same view as we did with EDV, but actually on a much smaller allocation to the portfolios. That gives us some cash that we can be mobile with markets. It introduces incredibly strong convexity, which is the non-linear payouts there. So this product here, you'll see some of that. We switched them out. EDV for RFIX, that's the ones you'll see in your portfolios now. Again, nothing changes about the underlying safe product backed by treasuries, just trying to find a better way to bet on rates going down in an ETF wrapper. So on the right side, kind of the matrix we have there is just for illustration purposes. We use this with some of the data they released in the paper that they released on this product. And we kind of plugged in some of our own numbers, how we would play it in the portfolio. This is a scenario analysis. What it's trying to do is look at the spectrum of what if rates go up 2% on the far left there, and what if rates go down 2% on the far right there, left and right, sorry. And you just look at the bottom portions there where it says net portfolio return, just below the gray intermission. And what we can see is when we hold U.S. Treasury, long-term U.S. Treasuries like we were prior, or if we hold this new product, the downside is pretty similar. If rates go up, how will we be punished? And for rates to go up from 4.8 to 6.8 in this scenario analysis, it's it's a tough stretch. There's no desk that believes that that can happen without calamity. But assuming that it does, our downside is symmetrical with EDV. When we look conversely to what happens if rates go down, that's what we really want to happen. That's what we forecast to happen. And what we see is that our new product offers much higher upside versus the prior holdings of EDV. And so if rates go down, 2%, EDV would net to your portfolios of about 6.5% there. The new products will go up about 13%. So you see this very strong upside downside multiple from the new product over 3, offering 3 times upside to its downside versus 1.5 essentially for the prior product. Better mousetrap, same underlying, not much changes, just a better intelligent design to express the same view. Anybody has questions, let us know. You'll see that ticker change come out of the portfolios. We are not relinquishing our view on long-term bonds. We are just getting more proficient at expressing that.
I think it's a great strategy, Trey. Next slide, it talks a little bit about the consumer sentiment by political party preference, red, white, and blue slide. And as you would expect, the party in power feels much better about the economy, how things are going, versus the party that's not in power. So this is years on the x-axis, and when Trump was in office, the Republicans were very happy, Democrats were not as happy. Middle of the road is kind of the independents, you would say. And then during the Biden administration, the Democrats were very happy, Republicans were not. But then Trump got elected, you're seeing this rise up. But I think what's interesting is the Republicans seem to be very, very happy when Trump's in office, and the Democrats, regardless who's in office, there's really not a lot of difference where Biden or Trump was in office. I thought that was just kind of interesting. But, conservative media thinks we're going to be able to avoid a recession. We're going to have a great time. All these changes are going to be wonderful for the country. Who knows? We just don't see it from the economic data. We do believe a smaller government and less regulation is good, and the markets are agnostic. Who's in the White House? All they care about is it easier to make money or more difficult? So I think the cut in regulations would do a lot to help the markets. So last slide we finished with, this is our option heavy portfolios that a lot of you are in that provide the income and paycheck for you. And the bottom line is we're able to produce what we told people would be able to do. The stock income portfolio, over 20% of it was sitting in a non-stock position for all of 2024. So we still generated just under 8% for the year. So that completes our webinar. I'm going to go ahead and stop recording, and we can open this up for questions.